So just a very quick uh, pointers in preparation for your exam. These are the things that should help you, and these are the things that should already be part of your stock knowledge. First would be the terminologies. Expect that there will be questions wherein you would be tested on your knowledge and the definition of terms, or simply uh, questions wherein you can get the correct answer so long as you're familiar with the terminologies. So, of course, if we're talking about raising capital for the company, we will be talking about initial public offering. Okay, so everyone is expected to be familiar with what an initial public offering is. An initial public offering refers to an event of a firm offering ownership shares in the firm to the general public for the first time. So this is the first time that the company is selling its shares to the public. And if you have your initial public offering, you have your secondary public offering. All subsequent offering of shares after the initial public offering would be considered as a secondary public offering. Okay, this is when companies offer additional ownership shares for stock that is already uh, publicly listed or already sold in public. Number three and four, uh, you'd also have to talk about primary markets and secondary markets. Primary markets are where securities also are sold for the first time. Okay, and just to clarify a potential point of confusion, it's not correct to say that initial public offering will go to your primary market while secondary public offerings will go to your secondary market. Okay, so please do not develop that confusion. Any share, whether it is a part of an initial public offering or a secondary public offering, will go through the primary market if it is the first time that that instrument or security is sold. So all securities will have to go through the primary market. After they have been sold for the first time, all subsequent trades for those securities will already be considered as taking place in the secondary market. Okay, so please do not confuse primary and secondary market with initial public offering and secondary public offering. Even secondary public offering will go through first to your primary market. Afterwards, it would go to your secondary markets. In the same regard, securities forming part of an IPO can also go through the secondary market after it has already been sold in the primary market the first time. Okay. And you also have to be familiar with money market and capital market. So the point here is as to the nature of the instruments that are being traded. Money market is a type of a secondary market wherein short-term debt instruments are traded. Okay, and then capital market, a financial market in which equity and debt instruments with maturities greater than 1 year. So money market, if we're dealing with short term. Capital markets, if the maturities are greater than 1 year, and also equity instruments. If you'll notice, in capital markets, it mentions equity and debt instruments with more than 1 year. Okay, but in money market, it only mentions short term debt. So equity instruments are not traded in the money market because obviously equity instruments do not have any maturity. Number seven, you also need to be familiar with the persons involved in the issuance of shares. Commonly asked questions would revolve around brokers and dealers. A broker is a market specialist who facilitates exchange between buyers and sellers. Dealers are market specialists who facilitates exchanges by buying and selling securities. So for dealer, the dealer itself buys it and sells it later on. For the broker, it does not buy it, but it will only facilitate an exchange between a buyer and seller. So please take note of the distinction. And of course, a commercial bank will also be involved. A commercial bank is a bank that offers financial services such as checking accounts, savings accounts, lines of credit, and loans. Uh, then we also have the different steps or processes involved in the issuance of shares and other securities. You have your underwriting. This is the process by which investment banks help a company complete the sale of a security. It is the process by which an investment bank agrees to buy the firm's securities and then resell the securities to investors. There will always be a question involving underwriting, so make sure to be familiar. Then underwriting spread, this is the difference between the price paid to the issuing company and the price the securities are sold to investors. This is the income that will be earned by the underwriter. So basically, the underwriter will guarantee the sale of the securities that are to be issued, and then it would be the underwriter who would look for buyers for the securities. Okay, in that scenario, the underwriter, the issuing company is basically guaranteed of a agreed price. Then the income on the part of the underwriter will come from the underwriting spread. So if the underwriter will be able to sell it at a price greater than the amount it has paid to the issuing company, then the underwriter will be able to earn a profit. You also need to be familiar with the term origination. This is the process by which investment banks ready or prepare a debt or equity security for sale. Then I wanted to point out marketability and liquidity because these are the definitions that you should be following. It's very easy for us to confuse the definition provided for marketability as the definition for liquidity, since our common usage of the term liquidity sometimes already uh, include the definition given here for marketability. So our definition for marketability would be the ease in which a security can be converted into cash. Again, it's very common for us to think that this is simply our definition for liquidity. So please take note, the ease by which a security is converted into cash will be marketability, while liquidity would be the ability to convert an asset into cash quickly without loss of value. So very important addition here is that there will be no loss of value. Underpricing is related to the issuance of the securities. There is underpricing when new securities are offered for sale at a price below their true value. Okay, just in case it would be asked, although the definition is very understandable and self-explanatory. And next would be insider trading. There will always be a question on insider trading. So make sure you're familiar with the definition. Insider trading is an illegal practice where individuals with confidential or non-public information, so either confidential or non-public information, trade on investments for profits. Last would be information asymmetry. This is relevant in your efficient market hypothesis. There is information asymmetry when one party in a transaction has more information than the other party. In case you'll be asked as to the steps in the origination process of securities, you begin with the origination process, followed by the preliminary prospectus, and then the underwriting process, and then lastly, the actual trading of the securities. Next, what are the functions of financial markets? Financial markets are there to reduce risk by creating liquidity and marketability to securities. They are there to mobilize funds within entities and providing an opportunity to earn higher returns. And then they are there to aid companies in raising capital by providing access to different kinds of participants regardless of size. So this can easily be asked as a multiple choice question. Which of the following is not among the functions of a financial market? Financial institutions involved in the issuance of securities would be your investment banks and your credit rating agencies. Okay, you could be asked questions involving this one. So, what are the typical functions that are performed by investment banks? Investment banks perform underwriting securities or helping a company complete a sale of a debt or equity instrument. They are also involved in selling or trading a company's debt or equity securities to interested investors. So, this is just related to the underwriting function. Next would be to offer advice on whether a company should raise capital using debt or equity, offering advice on features to include in a bond offering. So anything in relation to the issuance of your securities. Next, for your credit rating agencies, what are normally the roles of a credit rating agency? They are there to lessen information asymmetry by assigning ratings. The public can have an idea as to the risk exposure or the default risk that is being faced by a certain company that has publicly traded instruments or securities. Credit rating agencies also educate investors as to the riskiness of a debt, and they also assess the company's default risk. Again, this can be asked as a multiple choice question, so please be familiar with this one. Uh, for underwrite for the sale of the securities, there can be two arrangements: a firm underwriting commitment or a best efforts agreement. In a firm commitment underwriting agreement, from the name itself, there's a firm commitment. So the investment banker guarantees the issuer that it will receive a certain amount of proceeds. And that happens because the investment banker will purchase the securities from the issuer and then resell it at a price in order for it to earn a profit. Okay, benefit here on the part of the issuing company is that there is a uh, guarantee that certain level of proceeds would be realized from the issuance of your shares. So there will be no concern that the shares will not be sold, because if their securities are not sold, then you are not able to raise the capital needed. Uh, an alternative, the arrangement between the bank and the uh, issuing company would be through a best efforts agreement. From the name itself, it will just depend on the efforts of the uh, investment banker. So the investment banker will do its best to sell the securities to investors without guaranteeing any proceeds. So basically, the risk here would be on the part of the issuing company. So if the price is set very high, then the securities may not be sold. So the issuing company may not be able to uh, raise the needed capital. In this case, since the investment banker will not be profiting from the sale of the uh, securities, since it will not buy the securities itself, the investment banker's income will come in the form of a commission. It will get a percentage of the proceeds. Okay, so please take note, in a best effort agreement, the issuing firm will lose, meaning the company seeking to raise capital will lose if the offer price is set too high, because you might not have any buyers and you will fail to raise the needed capital. Next would be the efficient market hypothesis. Please be familiar with this one. There will always be a question on efficient market hypothesis. In the efficient market hypothesis, this is a theory of how well markets are able to reflect information in security prices. This tells us that the market prices uh, is influenced by the uh, information available. Inversely or conversely, uh, prices are also affected by the amount of information that is uh, made available to the investing public. And there are three forms the of your efficiency in the market. You have the weak form, semi-strong, and strong form. So there will be a lot of questions wherein you will be asked to determine whether what is being described is the weak form, semi-strong, or strong form. By the way, very important takeaway would be that in an efficient market, prices adjust to new information as quickly as possible. So please remember this one. So for your weak form, security prices reflect all past information but not all private or public information. Uh, Whereas in semi-strong form efficiency, security prices reflect all public information. So as to this part, weak form and semi-strong are the same. But unlike the weak form, uh, sorry, not no no not the same. For weak form, it's past information only, and then security in semi-strong, you also have the past information, and you also have public information. It's just that you do not yet have the private information. The security prices, the price in the market does not reflect all private information. Whereas in strong form, not only do you have past information, you also have public information, but you also have private information. So again, weak form, past information only, uh, and then not all private or public information. And then for semi-strong, you have the past information and all public information. For strong form, you have all past information, all public information, and all private information. Okay. The strong form is ideal. In this scenario, prices would be able to adjust for every information. Prices adjust to new information as quickly as possible. If the strong form efficiency holds true, it would not be possible to earn returns greater than market averages. So everyone would basically the playing field would be leveled if everyone has access to this information or that the prices already reflect all information, uh, all available information. So there will be no disadvantages. There will be no uh, undue advantage from those having information that are not available to other potential investors. And going back to weak form, uh, investors could not earn returns greater than market averages based on historical patterns in security prices, but rather only by trading based on public or private information. And then for semi-strong, investors who have private information could acquire such information through analysis of the firm or discussions with a firm's customer. So here, they can have more earnings compared to a person that does not have any access to uh, private information. So again, remember that there are three forms: weak form, semi-strong, and strong form. There will be questions, class, wherein you will just be asked which one of the following is not among the form under the efficient market hypothesis. Okay, so the questions may the choices will give you a made up option. Okay, and you can easily determine that that is the made up choice because you know already that the forms are just weak form, semi-strong, and strong form. Possible source of error on the part of the students would be they would forget semi-strong, but instead they will remember semi-weak. Again, it's not semi-weak, it's semi-strong. Weak, semi-strong, and strong form. basically you are increasing the strength. From weak, only past information, only all past information are available. For semi-strong, all past information plus all public information. For strong form, all three are present, meaning all past, public, and private. Again, please take note of this one. There will always be a question on efficient market hypothesis. For miscellaneous items, there will also be questions on the benefits of paying dividends. Okay, and these are: some investors prefer dividend paying stocks and will be willing to pay a higher price for stocks with regular dividends. Okay, by paying dividends, you make your stocks more attractive to investors. Paying out large regular dividends can force management to regularly raise more capital. The extra scrutiny involved in raising capital can increase the incentives of management to run the company efficiently. And then dividends can be used to manage the capital structure of a company. There's a choice wherein it would say whether or not it's true that paying dividends can help lessen the possibility of a company being in distress. That's incorrect. If you pay dividends, lesser cash is made available to the company for its operation, so it can possibly make the company more in financial distress. Okay, so please take note of that possible option or possible way of presenting this topic as a multiple choice question. Then there will also be questions on stock split and stock dividend. A stock split does not change the amount as to the effects of stock split and stock dividends. A stock split does not change the amount in any asset, liability, or the stockholders' equity account. In a stock split, the number of shares outstanding would increase, but the par value of the stocks would decrease proportionally, resulting in the amount of common stock remaining the same. A stock split would not generate increased income for stockholders, but it will result in an increased number of shares representing the same percentage of ownership. If you have stock split, there is also a reverse stock split. Okay, so please take note that the effect would be different, meaning the number of shares outstanding would decrease because you are getting back the shares and issuing back fewer shares in return. But as a result, the par value would increase. And whether it's reverse stock split or a regular stock split, your common stock will still remain the same. There will be no change to your assets, liabilities, or stockholders' equity. If we have stock split, there is also a stock dividend. When a company issues a stock dividends, earnings per share is affected in that it decreases as the number of shares outstanding increases. So one effect of a stock dividend is that earnings per share will go down because the number of shares outstanding will go up. Here, there's no effect on the par value. It will remain the same, unlike your stock split. Okay, but similarly, there will also be no effect of total assets, total liabilities, and total stockholders' equity. So I hope you'll be able to absorb the similarities as to the effect on your assets, liabilities, and equity for both stock split and uh, stock dividends. In the practice questions, there are questions there involving computation for stocks on the topic of stock split and stock dividend. Please make sure to practice on those questions, as there will be questions that will come out of this topic. So hopefully these pointers will help you.